The Schwab US Dividend ETF is good for investors who want to build passive income because it has growth potential, a solid return, and strong dividend growth. We believe that over time, the power of increasing dividends through SCHD can give you money that can change your life. SCHD is a good long-term investment because it gives buyers a diversified and low-cost choice for both yield and dividend growth. In this video, we'll take a closer look at SCHD and use a simple case to show how, over time, it could give you money that could change your life. Charles Schwab Corporation, which is based in San Francisco, California, is one of the best trading firms in the world. Since it was started in 1971, the company has grown to become one of the biggest banking companies in the United States. It has millions of customers, brokerage, banking, and wealth management services. One of Charles Schwab's best-known platforms is the Schwab US Dividend Equity ETF, which trades under the symbol SCHD1 to follow the Dow Jones US Dividend 100 Index, which comprises 100 US companies with high dividends. The SCHD ETF has done very well financially over the past few years. The strong success of companies in the Dow Jones US Dividend 100 Index has led to steady growth in the fund's revenue and earnings. The fund has also kept good profit rates that have stayed the same over the past few years. When compared to other funds in the same industry, the SCHD ETF's valuation measures have stayed good. The price-to-earnings ratio of the fund has stayed about right, which shows that it is trading at a fair price. The fund's price-to-book ratio has also stayed good, which shows that investors are ready to pay more for the high-quality dividend-paying companies in the fund. In terms of how the market has done over the past few years, the SCHD ETF has shown steady growth. The fund has always done better than its benchmark, which is the Dow Jones US Dividend 100 Index, and has given buyers good returns. The fund's trading volume has also stayed steady, which shows that investors are confident in its long-term chances. The SCHD ETF is part of a larger business that is very competitive. Many companies offer similar products to investors. However, the SCHD ETF has found a place in the market by focusing on high-quality dividend-paying companies. This has helped the fund give buyers good returns. Now, let's look at how you can start investing in SCHD ETF and making money from it. You can trade the stock market in many different ways. You can take the high-risk approach, a better approach, or a mix of both. But the $50,000 investment in SCHD ETF is just the right financial push you have been looking for, which can even make you quit a full-time job. Here's how. You can start with a small amount of money and invest in the S&P 500, the whole market, certain sectors, and so on. Exchange-traded funds, or ETFs, have made this easy to do. Today, you can choose from thousands of ETFs, some of which are very close to each other and some of which are very different. The Schwab US Dividend Equity ETF is my ETF when it comes to dividends. This is because the SCHD checks many boxes. Possible growth? Check. Good return? Check. Strong growth in dividends? Check. If you do not already know, I like investing in dividend stocks because I like the idea of building a passive income stream and using the power of compounding. This does not mean I do not invest in growth stocks, because I do, but I like to use profits to build passive incomes. The S&P 500 is one of the best and safest ways to invest over the long term in terms of success. When you buy an S&P 500 ETF, VOO, you own a piece of 500 of the best companies in the country. SCHD owns many companies in the S&P 500, and it's been able to keep up with the index and even slightly beat it over the past 5 years in terms of total return. If you remember, the power of compounding is when you use the income you get from an ETF or an individual stock to buy more shares. No more money was taken out of your account. Instead, you use the passive income you are getting to buy more shares. When you buy dividend stocks or exchange-traded funds, ETFs, that regularly raise the dividends, like SCHD, you get more shares and a higher dividend, which means your dividend income goes up. If you keep doing this for a few years, you'll see how the income snowball works to your advantage. At first, the income is low, but dividend investing is a long-term process. You buy more shares every year, and the payout keeps increasing. Early on, you probably don't need the dividend income. So if you start early enough, you could build up a nest egg that you could possibly live off when you retire. We all have to start somewhere, whether it's $50, $500, $1,000, or $50,000. Just do what you can and keep going. Let's move quickly forward by taking a look at what SCHD is made of. When SCHD began trading in 2011, it was run by Charles Schwab and had a low expense ratio of 0.06%. This means that for every $10,000 you invest, you would pay a fee of $6, which makes it a great low-cost choice. It's an ETF that invests in companies that pay dividends across many industries. It tries to follow how the Dow Jones US Dividend 100 Index does. One of SCHD's positions, Broadcom, AVGO, has made a big move in the past few days, making it even easier to stay on top of SCHD. There are only 104 positions in SCHD, and the top 10 slots make up 42% of the whole fund. SCHD pays a 3.7% dividend that has been growing at an average yearly rate of over 15% for the past 5 years. Example 1. Starting an investment of $10,000. We'll walk through a hypothetical case in which we start investing $10,000 in SCHD once and never add to that position again other than by reinvesting dividends. Since each share of SCHD is currently worth $70.59, you'll be able to buy about 142 shares of SCHD. After the first year, your dividend income would be $374, which, at the price of the stock today, it's enough to buy 5.3 more shares. If you look at the table, you'll see that the number of shares we own goes up yearly without us adding more money. This is what compounding looks like in action. In this case, we are assuming a return of 12%, which is less than the average return over the past 5 and 10 years. If we keep doing this for 10 years, you can see how our dividend income will go up from $374 at the start to about $2,000 per year, based on averages we use in the case. That is great, but $2,000 monthly income a year is not enough to live on and will not be that life-changing. Example 2. Starting an investment of $10,000 and adding $5,000 a year. So let's look at a better way to do things that really puts the power of compounding to work. In this case, we start with our original $10,000 investment. We'll reinvest our dividends the same way, but now we'll add an extra $5,000 to SCHD every year. This comes out to about $415 a month. We would get the same $374 from dividends in the first year, but instead of just adding the dividend income each year, we also add the $5,000 each year. This means that by the 5th year, we have almost $2,000 in dividend income, which is almost half as long as it took us in the first case. But if we keep doing this for 19 years, based on our assumptions, we would end up with almost 1,395 shares of SCHD and nearly $50,000 in cash income each year. You'll have to put $100,000 into SCHD by the end of the 19th year. $50,000 a year from one investment and raising can change many people's lives, including yours. Tips for investors. SCHD is a great choice for investors who want a good yield and a strong dividend growth, which is a mix I like a lot. The ETF adds a layer of safety because it has 104 different positions, but when one sector moves as strongly as technology has, the tech-heavy S&P 500 is likely to do better, which is what's happening in 2023. But aside from your original or compounding investment, You should aim to be a long-term investor who keeps building their position in this strong dividend ETF. Remember to subscribe to our channel if you found this content valuable. I'll see you in the next one.